Have you ever wondered how the stock market, a vital part of today's global economy, came into existence? The story begins in the 17th century in the bustling city of Amsterdam, the Netherlands. In those days, Amsterdam was a vibrant hub of commerce, teeming with merchants from all corners of the globe. Yet, it was not spices, silk, or gold that would set the stage for a financial revolution, but rather the establishment of the Amsterdam Stock Exchange in the year 1602. This was the world's first official stock exchange, a place where people could buy and sell shares of companies. The concept was simple, yet revolutionary. Companies could raise capital by selling a part of their business in the form of shares. These shares or stocks represented ownership in the company and could be bought, sold, or traded on the exchange. One of the first companies to take advantage of this new system was the Dutch East India Company, a powerful multinational corporation with far-flung trade networks. To fund its voyages to the East Indies and beyond, the company issued shares to the public, essentially turning investors into partial owners. The Amsterdam Stock Exchange facilitated these transactions, providing a centralized platform where buyers and sellers could negotiate prices. But it wasn't just for stocks. It also hosted the trade of bonds, financial instruments that represented a debt owed by the government or a corporation to the investor. This innovative approach to financing transformed the way businesses operated, allowing them to access vast amounts of capital and share the risks and rewards of their ventures with a wider pool of investors. From these humble beginnings in a Dutch trading house, the stock market has grown into a critical component of the global financial system, shaping economies and influencing the fortunes of individuals and nations alike. This was the first step in a journey that would change the world of finance forever. How did Wall Street become the financial epicenter of the world? It all started in the late 18th century, amid the hustle and bustle of New York City. There, under a buttonwood tree, 24 brokers signed the Buttonwood Agreement in 1792. This pact laid the groundwork for the New York Stock Exchange, which would later become a symbol of American economic power. The New York Stock Exchange, or NYSE, was not the first stock exchange in the world, but it quickly grew to be the most influential. It started as a modest operation, with brokers trading stocks and bonds on behalf of their clients. But as America's industrial might grew, so did the NYSE. It became the place where ambitious entrepreneurs met deep-pocketed investors, where fortunes were made and lost, and where the pulse of the American economy beat the loudest. Enter Alexander Hamilton, a man of great vision and even greater ambition. As the first Secretary of the Treasury, Hamilton saw the enormous potential of a robust and well-regulated stock market. He believed in a strong federal government and a modern economy powered by industry and commerce. And he knew that for this vision to become a reality, America needed a stock market that could channel the wealth of the nation towards productive enterprises. Hamilton's policies helped establish the foundations of American capitalism. He championed the creation of the first Bank of the United States, which stabilized the young nation's finances and helped build investor confidence. He promoted government bonds to pay off war debts, creating a market for government securities. These moves didn't just strengthen the American economy, they also boosted the fortunes of the NYSE, turning it into a thriving marketplace where government bonds and company stocks were traded. As the 19th century rolled on, the NYSE grew in size and influence. It became the hub of American finance, the place where the wealth of the nation was put to work. It was the dream factory of the American economy, where entrepreneurs turned their ambitions into reality and investors reaped the rewards of America's industrial might. Wall Street was now in place, ready to become the financial powerhouse we know today. How did the stock market crash of 1929 shape the financial world? Well, let's take a step back and understand the scenario. The Roaring Twenties, a time of economic prosperity and optimism, saw a significant rise in the stock market. However, this boom was not built on solid economic fundamentals, but rather on speculation and excessive borrowing. This shaky foundation was bound to crumble, and crumble it did in October 1929. This period, known as the Great Depression, was marked by a catastrophic fall in stock prices that wiped out millions of investors. Over the course of a few days, the market lost a staggering 25% of its value. The crash didn't just affect Wall Street, it sent shockwaves across the globe, marking the beginning of a worldwide economic downturn. The impact of the Great Depression was enormous and far-reaching. Unemployment rates soared, reaching a peak of nearly 25% in the United States. Banks and businesses failed, and a significant number of people lost their life savings. The economic hardship brought about drastic changes in many aspects of life, from societal norms to political landscapes. The role of the stock market crash in this economic downturn was pivotal. The crash sparked a loss of confidence in American capitalism, leading to a decrease in consumer spending and investment. This, in turn, caused a decline in industrial output and employment as failing companies laid off workers. In the aftermath of the Great Depression, governments around the world took steps to prevent such a disaster from happening again. Regulations were put in place to control speculative practices and provide a safety net for investors. These measures aimed to make the financial markets safer and more stable. So, how did the stock market crash of 1929 shape the financial world? It forced us to acknowledge the inherent risks of stock market trading and the potential for devastating economic consequences. It highlighted the need for regulation, oversight, and responsible investing. The crash was a harsh reminder of the risks inherent in stock market trading. What has changed in the stock market since its early days? Well, if we were to time travel back to the 20th century, we'd find a stock market that's almost unrecognizable from the one we know today. Back then, trading was a cacophonous affair, with brokers shouting orders across bustling trading floors. It was an era where the ticker tape machine and the telephone were the most advanced technologies in use. Then came the digital revolution. The late 20th century saw the introduction of electronic trading, which forever changed the landscape of the stock market. No longer were we reliant on paper and human brokers to make trades. Instead, computers took over, executing trades with a speed and efficiency that was nothing short of revolutionary. With the dawn of the 21st century, the stock market evolved further. Online brokerage firms emerged, offering investors the ability to trade stocks from the comfort of their homes. This democratized access to the stock market like never before. Now, anyone with an internet connection and a few dollars to spare could invest in the stock market. This was a far cry from the early days when only the wealthiest could participate. Today, the stock market is a complex global entity. It operates 24 hours a day, 5 days a week, with trades happening in milliseconds. It's influenced by a myriad of factors, from geopolitical events to tweets from influential figures. It's a testament to the incredible pace of change and innovation that's characterized the last 100 years. But amidst all this change, it's worth noting what stayed the same. The stock market, at its core, is a marketplace. It's a place where buyers and sellers come together to trade. It's a place where companies raise capital to grow and where investors hope to grow their wealth. Despite all the technological advancements and shifts in how we trade, this fundamental principle has remained constant. Despite its evolution, the stock market's core principle remains the same: connecting buyers and sellers. How has technology transformed the stock market? This question takes us on a journey of rapid evolution, where the pace of change is as fast as the blink of an eye. For starters, technology has revolutionized the world of trading with the advent of algorithmic trading. This method harnesses complex algorithms to execute trades at superhuman speeds and precision, based on preset rules and strategies. With this, traders can process vast volumes of data and make split-second decisions that were once unimaginable. Then there's high-frequency trading. This is a more extreme form of algorithmic trading where speed is king. High-frequency traders use sophisticated technology to execute trades in microseconds. Yes, you heard that right, microseconds. This allows them to exploit minute price differences that may only exist for a fraction of a second. But it's not just the speed of trading that's changed. Technology has also brought about a seismic shift in accessibility. Remember the days when stock trading was the exclusive domain of Wall Street insiders? Well, those days are long gone. Today, with the rise of trading apps, anyone with a smartphone and an internet connection can participate in the stock market. These apps have democratized access to trading in unprecedented ways. They break down complex financial jargon into simple language, making it easier for the average Joe to understand and navigate the stock market. And it's not just about buying and selling stocks. These apps also offer a wealth of information, including real-time market data, news updates, and analytical tools. This empowers individuals to make informed decisions and manage their investments more effectively. But technology's role in the stock market doesn't stop there. As we move into the future, we can expect even more innovations, like artificial intelligence and blockchain, to further revolutionize the trading landscape. Technology has not only transformed trading, but has also made the stock market more accessible than ever. And with this, it's clear that the future of the stock market is not just in the hands of Wall Street insiders, but in the hands of anyone with a smartphone and a dream. How does the stock market influence global economy today? This is a question that has grown increasingly relevant in our interconnected world. Let's dive deeper into this topic. The stock market has evolved from a local trading venue into a global economic powerhouse. Major stock exchanges, such as the New York Stock Exchange, the Nasdaq, the London Stock Exchange, the Tokyo Stock Exchange, and others, have a significant influence on worldwide financial trends. These exchanges are like the heart of the global economy, pumping the lifeblood of capital into countries around the world. They provide a platform for companies to raise funds for expansion, development, and innovation. In turn, this drives economic growth by creating jobs and fostering technological advancement. But it's not just about the companies. Stock markets also provide an avenue for individuals and institutions to invest their money. This investment not only potentially yields a return for the investor, but also contributes to the overall economic development. In today's globalized world, the performance of these stock markets often reflects the state of the world economy. A thriving market can indicate a robust and growing economy, while a downturn can signal economic troubles. Moreover, stock markets are intertwined. When the New York Stock Exchange sneezes, the rest of the world catches a cold. This phrase encapsulates how a significant change in a major stock market can ripple across the globe, influencing other markets and economies. The influence of stock markets extends beyond borders. It impacts everything from the rate of inflation in a country to the purchasing power of its citizens. It can affect the exchange rates between different countries and can even have political implications. In essence, the stock market is a barometer of economic health and a catalyst for economic growth. It is a reflection of the confidence that investors have in a country's economy and its future prospects. Today, the stock market is not just a marketplace for buying and selling shares. It is a complex and dynamic system that influences and is influenced by the global economy. The stock market, once a local trading venue, has now become a global economic force. So, what have we learned about the stock market's journey? From humble beginnings, the birth of stock markets can be traced back to the coffee houses of 17th century Amsterdam. It was here that the first shares and bonds were traded, giving birth to the concept of a stock exchange. This pioneering move by the Dutch set the stage for the birth of modern capitalism, creating a platform where the idea of ownership could be easily transferred and wealth could be generated. As we moved across the Atlantic, Wall Street emerged as the financial heart of the world. With the Bretton Woods Agreement of 1792, 24 brokers kick-started what would become the New York Stock Exchange, setting the stage for a new era of trading. Wall Street's influence grew exponentially, shaping the American economy and becoming a symbol of economic power. But with power came great challenges. The Great Depression, that started in 1929, was a stark reminder of the stock market's volatility. The crash that led to this decade-long economic downturn was a pivotal moment in the stock market's history, demonstrating the devastating effects that market speculation and lack of regulation could have on the global economy. In the aftermath of the Depression, the stock market evolved and adapted. The introduction of regulations and reforms brought about a sense of stability and trust, allowing the market to rebound and thrive once again. The latter half of the 20th century saw remarkable growth and technological innovation, propelling the stock market into modern times. The role of technology in stock markets cannot be overstated. From ticker tape machines to electronic trading, technology has revolutionized the way we trade. It brought about unprecedented levels of efficiency and accessibility, allowing anyone with an internet connection to participate in the global economy. The advent of algorithmic trading and high-frequency trading further pushed the boundaries of what was possible. Today, the global stock market stands as a testament to centuries of evolution and innovation. It is a complex and interconnected network of exchanges that reflect the state of global economies. With trillions of dollars traded daily, the stock market continues to play a pivotal role in shaping our economic landscape. But despite its long history and significant evolution, the essence of the stock market remains unchanged. At its core, it's still a place where companies seek capital to grow and investors seek opportunities to build wealth. It's a place where risk meets reward, where fortunes are made and lost, and where economic trends are both reflected and influenced. Understanding the history of the stock market helps us appreciate its role in shaping economies and influencing global finance. The stock market's journey is far from over, and its future promises to be as exciting as its past.